Hello there, I hope that you are doing well. Welcome to the first educational lecture of the 2024 mentorship. Within this lecture, I'm going to share with you the foundation that is required to understand my internal dialogue of interpreting price action. Within this lecture, I'm going to cover with you the basics. This means that I'm going to cover with you the smart money paradigm, liquidity, inefficiencies, where we buy and sell, market maker models, and some other insights based on them. This lecture is going to be rather basic, but it's still very important that you take proper notes because this is the information that we will build upon during this mentorship. This is how I internalize price action, and I hope that at the end of this mentorship you will be able to see the same. If you put in the required work, if you put in the required time and effort, I'm sure you can. So let's dive straight into this lecture. So to begin this lecture, I'm going to discuss the smart money paradigm with you. The smart money paradigm is the paradigm through which I look at price action or the markets in general. The smart money paradigm basically consists of one main belief, and that's the following. I am of the opinion that all financial markets are absolutely rigged and controlled. These markets are rigged and controlled by certain entities. These entities used to set price manually, so that means that they used to determine the price of assets manually, so that it was done by humans. But when everything switched to technology, they automated this process and they created algorithms. These algorithms run based on time and price. That means that at certain times of the day, or of the week, of the month, or of the year, they are going to cause specific price runs within the markets. I must admit, however, that supply and demand holds a certain influence over certain markets. The markets that are influenced by supply and demand are real world assets. This means, for example, that the oil market or the wheat market or the grain market is influenced by supply and demand. However, even these markets show the same algorithmic signatures that we see within the derivatives markets or the other futures markets. Because think about futures this way. Futures are basically created out of thin air. And then you need to ask the following question to yourself. If they are created out of thin air, who's in control? Who determines the value of this futures contract? And there you have your answer to that question. Whether or not these markets are rigged and controlled. This is a belief that you might actually believe. This is something that you might actually start to accept. And I hope that by saying this straight away, that I have not shocked you, that I've not made you upset already, because this goes against everything that we have been taught as humans from the beginning of ages, basically. And please don't make this change your belief already or your excitement about this mentorship, because the precision that I will show to you guys and that I've already shown to you guys should already be a statement that there's certain validity behind this belief. Anyhow, enough about the smart money paradigm. Let's dive straight into the beginning of looking for algorithmic signatures within the delivery of price. Here we are looking at a simple schematic of a dealing range. Here we can see a dealing range with the prices from 0 to 100. The reason why I'm sharing with you this simple schematic is because this schematic is the foundation of how we internalize price action. We want to always buy in a deep discount relative to the current dealing range from 0 to 100, and we want to sell short or we want to sell in a deep premium. The reason why we want to do this is because of the following. Think about if you're going to the supermarket and let's say that you're looking to buy milk. Would you rather pay $3 for the milk or would you rather pay $5 for the milk? Of course, you would always pick the former. You would try to buy $3 for the milk because it's cheaper than the $5. But let's say that you're the owner of the store and the store owner wants to make as much revenue as possible. So your goal is to make profit. Would you rather sell the milk for $3 or do you want to sell the milk for $5? The answer is of course obvious. You would much rather sell for $5 because the amount of revenue that you get from that one product of milk is higher. Of course, there are other reasons that pricing is based on, but for this rather simple example, I'm just sharing with you where you want to buy and sell. When we look at financial markets, we are looking at the exact same paradigm because we want to buy in a deep discount. And a deep discount occurs when markets are going down. Why do we want to buy when a market is going down? Because when the market is going down, that brings with it fear. And we want to be hopeful when others are fearful. So that means when the masses are fearful, we want to be excited because we will look for opportunities to long that. That is how the algorithm is created. That is how smart money operates. They create a certain narrative to then do the opposite. They create fear so that they can fill their positions and then reprice higher. Then the opposite can also be said. They create hope when in reality you should be fearful. Because smart money is utilizing that run higher to sell short against in a deep premium. And that's how these markets move. Let's continue to the next theory that is required for our foundation. Here we can see the exact same D range but without all of the colorful stuff inside of it. Here we can see that there's a line on the lower end of the D range, which is a old low. Below this old low, sell side liquidity rests. You might be wondering, what is liquidity? Liquidity is basically engineered stop losses of retail-minded traders that place their stop losses below an old low. The market will try to gravitate towards these old lows and reject of them if the higher time frame or the flow is bullish. So that means if the market is predetermined to go higher, then every run on an old low, on a crucial old low so to say, is considered as a turtle soup. We will discuss this later on of course more. Above old highs, we see buy side liquidity. Buy side liquidity are engineered stop losses of shorts, and sell side liquidity are engineered stop losses of longs. Retail-minded traders long above old lows and they short below old highs. Here we can see the DN range, but I've added two boxes. Below sell side liquidity, smart money buys, and above buy side liquidity, smart money sells. If we think back to the first concept that I shared with you guys about where we want to buy relative to the current DN range, you might be wondering, how can we buy outside of the DN range? Or how can we sell outside of the DN range? If we see price trade below an old DN range, so in this case below an old low, this means that the market is now trading inside of external range liquidity. We will discuss this later on more because this requires a lot of chart work to transfer this knowledge to you, but just understand that outside of a dealing range, so below this black line, price is in a very deep discount relative to this dealing range. Above this high, price is also in a very deep premium relative to that dealing range. So what is price likely to do after trading outside of this range on either the upper end or the lower end? It's likely to retrace back into the range. This is something we will discuss later on in the mentorship more often because this is crucial to understand how the market moves. We are now going to discuss the second part of this lecture. During the first part, we have discussed ranges and liquidity, and now we're going to focus on inefficiencies. An inefficiency or an imbalance in price comes as a result of the algorithm that delivers price repricing too quickly. The term repricing is a term that I will use more often within this mentorship, so it's important that you understand what it means. Repricing basically means that price is being moved from one price to another. Repricing. Note that down, please. If the algorithm that delivers price reprices too quickly, gaps are a result of that. Price will seek to reprice into these gaps to offer smart money the opportunity to either buy or short at a fair value relative to the current dealing range. Therefore, fair value gaps exist. Now I'm going to take you with me to look at the two most common gaps or fair value gaps out there. The first fair value gap that we're going to look at is a bullish fair value gap. This is called a BC, a buy side imbalance, sell side inefficiency. This means that the imbalance was on the buy side and sell side was inefficiently delivered. So that means that at a later point in time, price will come back to this price range to rebalance this inefficiency. And here is the bearish fair value gap. This is a CB. This is a sell side imbalance, buy side inefficiency. This means that imbalance was on the sell side and the inefficiency was on the buy side. So it means that buy side has to be offered at a later point in time within this price range to balance this sell side imbalance, buy side inefficiency. Inefficiencies are a result of the algorithm repricing too quickly. Therefore, these gaps will be revisited at a later point in time to rebalance those price ranges before continuing with the move that was in the direction of the imbalance. So that means that if we're bearish and we're expecting lower prices and we see the creation of a CB, we anticipate price retracing back into that CB before it continues to fall lower. So now we can conclude what makes price move, or to what price draws to be precise. Price either draws to liquidity in the form of buy side liquidity or sell side liquidity, or it looks to reprice into an old imbalance to rebalance that imbalance. Let's continue to part 3. We're now going to combine theory. So let us now take a look at the first market maker model. The market maker models are the models through which I internalize price action. These models are used to put structure in play for my internal dialogue when it comes to looking at price action. When we're looking at the first model that we're going to discuss, we can see that this is a market maker buy model. A market maker buy model is a bullish model. This model occurs in bullish markets mainly in the cleanest form but it also occurs in bearish markets. Later on, you will learn why and how. First of all, we're going to do some pattern recognition. For the market maker buy model, it is crucial to understand that there's an original consolidation somewhere. This is where the market was being held inside of a range where buy side liquidity got engineered. Retail minded traders will look at this consolidation up here and think to themselves, this is strong resistance. The market then begins to fall. It retraces, continues to fall, retraces, it continues to fall, it retraces and continues to fall. This delivery of lower prices on the left side of the curve is what we call the sell side of the curve. Sell side delivery is in play. This means that down close candles are getting delivered on the left side of the curve. This is occurring because price is drawn towards this key level. For this lecture, we're going to say that this key lecture is a higher time frame BC, a bullish fair value gap, a buy side imbalance, sell side inefficiency. The market reaches this level and we see a turtle soup form, and then we see displacement to the upside. You might be wondering, displacement, what is that? Displacement is basically the move that changes the delivery. So that means we were delivering lower on the left side of the curve. We displace above a certain high. Which high, you might be wondering? This one. And from there on, we believe that buy side is now going to get delivered. So that means up close candles are likely to come. The change in the state of delivery is a term that is hard to understand. The theory behind it is hard as well. But to begin, we're going to focus solely on this high getting broken right here. When this high gets broken, we believe that the market is now going to deliver higher and that the algorithm has showed its hand to us and that we now know higher prices are next. When we take a look at this schematic, I want you to imagine the following. I want you to take a look at this leg right here. What do you think consists in this leg? A CB is inside of this leg. The market will retrace into that, create a high, and then distribute to the downside, deliver lower. We then see a smart money reversal here. This is where smart money buys below that key level inside of that higher time frame BC, that higher time frame fair value gap, below an old low in a deep discount. We then see displacement to the upside, change in the state of delivery. What will the market now do? It will retrace into what? Into an imbalance that forms inside of this displacement leg and into this high right here. One thing I want you to focus on when studying the market maker buy model, but also the market maker sell model, is this change in the state of delivery. Because what you will often see is that there's a CB inside of this leg, a high gets formed. This is what I label as an intermediate term high. And when I see that the market displaces above this intermediate term high, that's the change in the state of delivery for me. So the next retracement into ABC and into preferably also the price range from this high to this low, that's a buy for me. We then see continuation higher, market engineers more buy-side liquidity below the original consolidation, retraces, smart money buys more, and continues higher. Price trading into this key level is the inception of the market maker buy model. With inception, I mean the moment that higher prices are getting delivered. So that means the moment that the smart money reversal takes place. The terminus takes place when price crosses the high of the original consolidation. How price trades above this high or above these engineered highs determines what will follow next. Here we are at the market maker sell model. For the market maker sell model, I want you to completely inverse the logic that was just described to you with the market maker buy model. But here's a quick breakdown. We see that the market is consolidating in here and begins to expand to the upside. Retraces, it expands. It retraces, it expands. It retraces, it expands. Until it reaches this key level. This key level is the low of a daily CB. Market trades into that level. We see a turtle soup form. Market displaces to the downside and retraces. Retraces into what? Into this low right here, which is an intermediate term low, and it is important because it formed inside of a BC, inside of this price range, and it was the last low that formed before the expansion into our key level. When we then see the displacement below that, this is our change in the state of delivery, or our market structure shift, or our break in market structure, whatever you want to call it. It's the signal that we're now from buy side delivery switching into sell side delivery. The market begins to fall, retraces, offers buy side into what? Into a CB that forms inside this price range. Expands lower, retraces, and eventually hits terminus. The pattern of a BC, intermediate term low, CB, is something that I will touch on more often in the future, and more lectures will be made around that topic. Because detecting the change in the state of delivery is by far one of the most crucial skills to learn. So, we are coming to the end of this lecture. Within this first educational lecture, you got introduced to the foundation of learning how I view the markets. Was this hard? For the newcomers, you might feel like this was very advanced knowledge, and that's logical. But over time, when you get more experience, you will think back to this first lecture and you will realize how simplistic it truly was. There are levels to be achieved, there are levels to the markets, and the levels that are present every single day and week that define where you are at are a result of the amount of effort that you put into learning this. So, watching my lectures, watching my reviews will not be enough. You will have to put in the work yourself. You will have to go out there, you have to study, and you have to work in an organized manner. For the remainder of December, another lecture will be shared with you guys, in which I will actually break down multiple trades that I took during the month of November and December. These breakdowns will be done at advanced level, so that means that I will bring up concepts that were not discussed during this first lecture. So if you feel like that lecture will be too much in terms of, whoa, what is this? Don't worry, because this lecture is just going to be a showcase of what is possible, first of all, and secondly, what we're going to get you towards, hopefully in the upcoming periods. Thank you for listening and watching to this first lecture, and I wish you a nice day. Be safe.